Welcome to the Tax Roundup, where we're exploring the latest developments across the month of April. Now that a federal election has been called, we're not going to really see any developments in the legislative space for the next little while, but that doesn't mean that nothing else has been going on. This month, we're looking at a High Court decision which deals with the world of trusts. There's been a lot of developments in that space recently, and this takes things just a little bit further. So we'll have a look at what that case means and the practical implications. There's been another interesting case that's also gone through the tribunal this month too, focusing on whether a taxpayer could claim expenses for things like gym memberships, supplements that they were taking, and also travel expenses. Matt will delve deeper into how that case played out and what it might mean for our clients as well. And to wrap up the roundup for this month, we're going to be looking at a recent update in terms of the tax treatment of COVID-related state government grants. This is an area that we're being bombarded with questions on and have been for some months now. And the government has introduced some additional grants that can qualify for tax-free treatment. So we'll be taking a look at what the latest developments are.
So this new High Court decision on trusts, is this in any way related to the ATO's recent guidance on Section 100A, or is this something that's entirely different?
Yeah, it's a really good question, and there has been quite a bit of confusion on this to date. Because the High Court decision was handed down not long after the ATO released its Section 100A guidance, there has been a little bit of confusion with people thinking that the two things are related. They are in a small and broad way, but they really do deal with quite different things. The case that's just gone through the High Court, the Carter case is one we're referring to. It actually doesn't refer specifically to Section 100A. It deals really with the concept of present entitlement to trust income and to what extent a beneficiary can disclaim their entitlement to trust income. Now, the outcome of this case is effectively a win for the ATO, and it's the High Court, so this isn't going any further. But the outcome leaves a few question marks, and it's going to be interesting to see how the ATO actually responds to this decision, because to some extent what the High Court's saying, it feels to me anyway to be a little bit inconsistent with some existing ATO guidance. So it's just at this stage a little bit hard to reconcile where we're going with this. Look, just to give you a bit of background in terms of what this case dealt with, it's quite interesting from a technical point of view. Basically, we had a discretionary family trust with a number of beneficiaries. This particular trust deed had a clause in it that was designed to ensure that the trustee would never be taxed at penalty rates on unaccumulated income. So the trust deed basically said that if income hasn't been fully appointed to beneficiaries by year end, then it would automatically be appointed to certain named beneficiaries. And it turned out that there were 5 individuals who were effectively the default or residual beneficiaries for this trust. Well, we go back to the 2014 year, the trustee did not appoint all the income. In fact, it looks like the trustee didn't appoint any income by year end. And that triggered this default beneficiary or default distribution clause. So these individuals effectively became entitled to 1/5 each of the income of the trust for the year. Now, they didn't originally include any income in their tax returns. It appears that they weren't aware of this entitlement or the tax implications until the ATO issued some amended assessments to them. A few days after receiving those amended assessments, those beneficiaries, or at least some of them, tried to disclaim their entitlement. Basically said, I don't want the income and therefore I shouldn't be taxed on it. Well, it seems like those initial attempts to disclaim the income were ineffective. And the High Court doesn't go into why that's the case, but it seems to be accepted that those initial attempts, first 2 attempts, were not effective. Well, we fast forward another year or so, and these particular beneficiaries make another attempt to disclaim their interest. There's a formal document entered into whereby they try and disclaim their entitlements. And the ATO basically is saying, in this case, we don't think that was effective. Too bad, too late. You're going to get taxed on 1/5 of the taxable income of the trust because you were presently entitled to 1/5 of the trust income. So that's effectively what the case was, and that's what the court then had to decide. Could that disclaimer of income be effective in terms of then applying the tax rules?
Sounds like a really interesting case. So what did the court ultimately decide, and what does this mean for our clients?
Yeah, so this was an interesting case partly because the outcome changed as it made its way through the court system. So initially the tribunal found for the ATO and said that this attempted disclaimer of trust income wasn't effective because it happened after year end. And when it comes to determining tax impacts, when it comes to trust distributions, you've got to look at what happened before the end of the year. Well, that decision was appealed and the full federal court actually flipped it around completely. The full federal court found that the disclaimers were effective. Effectively, what the full federal court was saying and agreeing with the taxpayers was that you can effectively disclaim an interest in trust income for a year, as long as you do that within a reasonable period of time. And to some extent, that's consistent with some guidance that we've seen from the ATO in the past. This idea of being able to effectively disclaim an interest in trust income as soon as possible once you become aware of it. And that could well be after the end of the income year. So the full federal court basically found that this disclaimer was effective. Well, that then got appealed to the High Court, and the High Court went the other way. The High Court went back to what the AAT decision was. The High Court focused on this concept of present entitlement. The legislation refers to a beneficiary being presently entitled to trust income. And the High Court, in a sense, was saying, well, if we let things that happen after the end of the year impact on that outcome, that could cause all sorts of practical problems. And so as a result, we really need to focus on what happened during that particular income year, and were these beneficiaries presently entitled to this income as at the very last point at the end of the relevant income year. Well, because they hadn't disclaimed their interest before the end of the income year, the High Court said they were presently entitled. As beneficiaries who were presently entitled at that point in time, they are therefore assessed on a share of the taxable income of the trust. So it doesn't seem like the High Court is necessarily saying that you could never disclaim an interest in trust income, but that you would need to do it before the end of the relevant income year. Now that presents some practical problems because in this case, the beneficiaries, they didn't know that they were presently entitled. They weren't aware of their entitlement until they received the notice of assessment or amended assessment from the ATO. And I suspect that would be the case in many situations where a beneficiary might want to disclaim their interest in trust income. They might not be aware until the end of the income year, or sorry, after the end of the income year. So I guess that's the first thing to take from this case, that if someone does become aware after the end of the year that they've been entitled to income, even if they don't want the income, if they want to kind of reject that gift that's been made to them, it may well be too late when it comes to applying the tax rules. So yes, they could reject the gift, but they're probably still going to get taxed on it. So the beneficiary would want to just have a good think about that before taking steps to reject the gift. The second thing is that what the High Court is really confirming here is that this is something that we are looking at the end of the income year. Things that happen after the end of the income year, whether it's a disclaimer, whether it's a trustee who now wishes they'd done something a bit different, once the income year is ended, it's probably too late to do that. Look, we come across situations where people say, well, the trustee made this decision just before year end to appoint income in a certain way. They now realise that they would have done it slightly differently, given the chance. Can they do that now? Well, what the High Court is saying is they probably can't. Once you get past that end of the income year, it's probably too late. Now, as I said earlier, it really remains to be seen how the ATO responds to this and whether the ATO will update some of its materials, given that this decision does seem to just conflict a little bit with some of the stuff that we've seen from the ATO in the past. So we'll wait and see. The ATO is likely to issue some sort of decision impact statement and possibly update its guidance, and we'll certainly let you know as and when that happens. Let's turn our attention to other interesting cases that's gone through this month. This is a tribunal decision in the London case. Matt, tell us what happened in this case and what was the taxpayer and the ATO arguing about in this situation?
Yeah, there was a AAT case where the judgment was just issued early this month, this April. It's called the London case, which dealt with the deductibility of gym expenses for employees. Now, before I delve into the detail of this case, it's probably just worthwhile being aware that it's generally quite difficult for employees to claim deductions for fitness or gym memberships. And that's because those expenses are normally seen to be private in nature. And the ATO does say that if you're an employee and trying to claim deductions for fitness or gym memberships, you generally need to show that your job requires you to have an extremely high level of fitness, and generally well above your general occupational group. Now, this AAT case, the London case, dealt with a taxpayer who was a dog handler in a special operations unit within the Department of Correctional Services. So he basically worked in prisons, okay? And as part of his role, he had to train, feed, or exercise dogs, including a German Shepherd. Now, importantly, as part of his job, he was also part of an emergency response unit that had to deal with emergencies that may happen from time to time in a prison. So that could include prison disturbances or riots, or even in the case of a prisoner escapee. And those emergencies, generally required him to exercise a high degree of physicality. Now, the taxpayer tried to claim some deductions for his gym membership fees, and the ATO basically knocked that back. And the ATO basically said, look, we get that you have to deal with emergencies at work. Those emergencies require you to exercise yourself quite physically, but we don't think that you can claim a deduction for your gym memberships, because those emergencies happen so far and few in between, and you're not required to exert yourself physically on a regular, ongoing basis as part of your job. Now, fortunately for the taxpayer, the AAT disagreed with the ATO. And the AAT member basically said, look, it's not so much that the emergencies happen far and few between, it's the fact that your job, being part of a special emergency response team, requires you to deal with these emergencies when they arise. So what that means is that taxpayer was required to maintain a high level of physical readiness in case these emergencies occurred. And that's why the fitness expenses were deductible. So I guess what this case is really saying to me is that if you're dealing with employees looking to claim deductions for their gym memberships, don't just look at individuals that are required to exert themselves physically on a regular basis as part of their job. You should also be looking at individuals who might be part of some sort of response unit or some sort of emergency team, where they're required to at least maintain an extremely high level of physical fitness, even though they may or may not have to deal with emergencies on a regular basis.
So Matt, I've seen some suggestions that this might, in a sense, open the floodgates to a whole bunch of people claiming deductions for fitness expenses, gym expenses, that sort of thing. Is that fair? Are we likely to see that happen? Is this something that could be applied by a whole bunch of people? Or is this something that's still quite limited in its scope?
Look, that's a good question, Mike. And yeah, I'm aware that there have been some comments that this case might be seen to have some broader implications, or even might open the floodgates on claiming deductions for fitness or gym expenses. Look, I don't think so. I mean, if you read the decision, even the AAT member said that, or made the comment that general correctional officers or general police officers who aren't required to exert themselves, in a physically demanding manner on a regular basis, and aren't part of some sort of emergency response team, probably wouldn't get a deduction for their fitness expenses. And also, the ATO did make some statements in response to this case, and they basically said, "Yep, we acknowledge the decision, but it actually doesn't change." Our interpretation at all. So, basically what I'm trying to say is that, look, it is an interesting case, but I just don't see it having wider ramifications to the broader population group. And that's because in order to claim deductions for fitness expenses, the ATO still thinks that you need to show that your job requires you to have a extremely high level of fitness that's well beyond or well above your general occupational group. And that view still stands.
Well, to wrap up the tax roundup for this month, we take a closer and updated look at what's going on in the world of COVID-related grants and how they will be taxed in the hands of business taxpayers.
So I saw in the budget that a number of COVID state grants might be made tax-free. So where are we up to with that?
Yeah, so we did see in the budget an announcement that some additional state government grants would be made tax-free. And the good news is that that has actually happened. So the Treasurer has issued another legislative instrument which increases the number of state government grants that can potentially qualify for tax-free status. Now, this has been a frustrating area for practitioners and clients because of the way the system has basically been structured. So we had some legislation passed a while back which gave the Treasurer the power to issue legislative instruments, basically making very specific state and territory government grants relating to COVID-19 tax-free. But that's kind of happened in a really piecemeal way. It's kind of been drip-fed. So following the budget, when some announcements were made that additional grants would be made tax-free, the Treasurer has issued another legislative instrument. So we now have some grants from the ACT, Queensland and South Australia that can be tax-free, in addition to a growing list of grants paid by the New South Wales and Victorian governments. Now, the key thing here is to remember that not all state and territory government grants relating to COVID will be tax-free. You need to refer to either the latest version of that legislative instrument or the ATO's guide. The ATO website has now been updated with a full list of all the grants that can qualify for that tax-free treatment. Unfortunately, for some people, you'll find that specific grants that clients have received are not on that list and therefore don't qualify for tax-free treatment. The other thing, of course, just to be aware of is that even if a client has received a grant that could potentially be tax-free, the client themselves needs to meet certain conditions. They need to be carrying on a business. They need to have received that grant in either the 2021 or the 2022 income years, and their aggregated annual turnover needs to be less than a $50 million threshold. So we need to look at both those aspects. Is the grant on the list, and then does the client themselves meet the basic eligibility conditions? Now, it remains to be seen whether additional grants receive that tax-free status. I guess the longer that we kind of progress along this path, the less likely it is, because we're seeing less grants being offered by state governments. But who knows? We'll wait and see, and we'll definitely keep you up to date if any further grants are added to that list. And that's the tax roundup for April 2022. Stay tuned as things develop in terms of the federal election. We might start to see some policies being announced that might relate to tax, super, those sorts of things. And we'll certainly keep you up to date as we see developments in that area. If you want to find out more about what Knowledge Shop does and how Knowledge Shop can and does help hundreds of accounting firms across the country, give us a call on 1-800-800-232 or jump online and we can give you a tour and show you exactly what Knowledge Shop can do to help you manage your practice in this ever-changing environment.